Have you ever found yourself wanting to buy or sell something in the financial markets, maybe a stock, and just wondered, how do I make sure what I want to do is like crystal clear? And, how are my interests actually protected in all this complexity? Welcome to the deep dive. Today, we're really getting into the foundational stuff of financial trading. We'll be looking at the different kinds of orders you can place, how these essential go-betweens, the broker-dealers, actually work, and some key strategies like, going long or going short. Yeah, this deep dive is built on some really comprehensive sources that detail the precise mechanics of how trades get executed. Our mission really is to give you the knowledge to understand these kind of subtle but really significant differences that affect your investments. Things like how your broker makes money or how you can get really precise control over your trades. We're going to try and cut through the jargon, get to the crucial insights. Okay, so let's unpack this a bit. Before we even get to placing an order, it's like super important to understand who is executing your trade and what hat they're wearing when they do it. So first up, when you're dealing with a firm that's acting as a broker, they're basically an agent.
Right, an agent. Their job is essentially to connect you, the buyer, with a seller, or, the other way around. The key thing is they're not using their own inventory of stock. They're just finding the match for your trade.
So they don't assume the risk themselves.
Exactly. No risk from holding stock. And for making that connection, they earn a commission. That's a separate dollar amount you'll see listed clearly on your trade confirmation. Simple as that. No trade, no commission.
Okay, so that's the broker as an agent. How's that different from a dealer?
Well, a dealer acts as a principal. This is quite different. They are buying securities for their own account or selling securities from their own account, their inventory.
Their own inventory. So they are taking on risk.
Precisely. By holding that inventory, they assume risk. Now, a dealer who's always ready to buy or sell a particular stock, they're known as a market maker. And they provide what's called a two-sided quote.
A two-sided quote, meaning they're showing both prices, buy and sell.
Exactly. They quote a bid price, that's the price they're willing to buy at, and an ask or offer price, the price they're willing to sell at. So if a dealer quotes, say, $19.90 bid and $20.25 ask for a stock, they'll buy it from you at $19.90, but they'll sell it to you at $20.25.
And that difference, the 35 cents.
That's the spread. And yeah, that spread is a primary way they make a profit. It's their compensation for providing liquidity and taking on that inventory risk.
Okay. And these quotes are usually for, standard amounts, 100 shares.
Typically, yes, for round lots, which are multiples of 100 shares. If you trade less than 100, that's called an odd lot. But don't worry, you can usually trade whatever number you need.
Right. Now, you also hear about markups and markdowns. Are those extra fees on top of the spread?
They're related to the dealer model. When a dealer acts as principal for, say, a retail customer like you, they'll adjust the price. It's a markup if they're selling to you, making the price a bit higher than the inside market ask. Or it's a markdown if they're buying from you, making the price a bit lower than the inside market bid.
Okay, what's the inside market exactly?
Good question. That's the best available price across all market makers. So the highest bid price and the lowest ask price currently available anywhere for that stock.
I see.
So, quick example. Inside market is, let's say, $20 bid, $20.20 ask. If you want to sell to your dealer, they might give you $19.95. That's a 5-cent markdown from the best bid.
Okay.
If you want to buy from them, they might charge you $20.26. That's a 6-cent markup from the best ask. These adjustments are kind of built into the net price you pay or receive, but they should usually be noted on your confirmation slip.
So the role they play, broker or dealer, really changes the transaction and how they get paid.
Fundamentally, yeah. And this obviously brings up a big question. How do we make sure these charges, the commissions, the markups, the markdowns, how do we ensure they're fair? What does FINRA do about that?
Right. The regulators must have rules for this.
They do. FINRA has what's known as the 5% markup policy. Now, its purpose is basically to stop firms from charging unfair or excessive amounts. But it's important to know it's more of a guideline than a strict hard rule. It applies across the board: markups, markdowns, commissions, whether they're acting as agent or principal, and for most types of securities.
A guideline.
Yeah.
So does that mean charges can be higher than 5% sometimes? And if so, how is that justified?
That's a really great point. It's not a rigid ceiling. FINRA looks at several factors to judge fairness. For example, the type of security matters. You might see a higher percentage markup on, say, a less liquid common stock compared to a government bond.
Okay.
Also, the availability of the security. If your broker has to put in a lot more effort to find the shares you want to buy or find a buyer for shares you want to sell, that can justify a higher charge.
Makes sense. Effort equals cost.
Right. And interestingly, the actual price of the security is a factor too. Generally, the percentage markup tends to be higher for lower price stocks.
Really? Why is that?
Well, think about the fixed costs of handling a trade, processing, paperwork, etc. Those costs are sort of a larger proportion of the total value when you're dealing with penny stocks versus, say, a $100 stock. So a 5% markup might not even cover costs on a very cheap share.
Ah, okay, that clicks.
The amount of the transaction matters too. Smaller dollar trades might justify a higher percentage markup for similar reasons, and disclosure helps telling the customer beforehand. But crucially, the circumstances must justify the higher charge, not just the disclosure.
So it's not a free pass just because they tell you.
Definitely not.
Mm.
Vine and Rar also looks at the pattern of markups. A firm that consistently seems to be pushing the boundary will get more scrutiny, even if individual trades might seem justifiable in isolation.
Got it. It's about the overall picture, too. And does the type of firm matter? Like if they offer research?
That can be a factor, yes. A firm providing extra services like research might justify slightly higher charges, but only if those services benefit the customer. They can't justify higher markups just for their own internal operating costs that don't add value for you.
Okay, that clarifies the 5% guideline quite a bit. What about proceeds transactions? I think I saw that mentioned.
Yeah, that's a specific scenario. It's when you sell one security and then immediately use that money, the proceeds, to buy another one.
Like swapping one stock for another.
Exactly. In that case, Fine and Raw says the firm should calculate the total compensation from both trades, the sale, and the purchase, and then figure out the percentage based on the proceeds from the initial sale.
Ah, so they look at the whole thing as one event, sort of?
Kind of. It prevents them from, say, charging the maximum on sale and the maximum on the purchase separately when it's really one continuous intention from the customer.
Yeah.
So if you sell $5,000 of stock A and buy $5,000 of stock B right away, the markup percentage is based on the total charges relative to that $5,000.
Okay. Are there any big exceptions to this 5% policy?
Yes, the main ones are securities sold via a prospectus. Think new issues like IPOs or municipal bonds, mutual funds. Those are sold at a specific public offering price, POP. So the market policy doesn't really apply in the same way.
Right, because the price is set differently.
Exactly.
So I guess the big takeaway here for, for you listening is that the real cost of your trade isn't just the share price. You've got to pay attention to those spreads, markups, commissions. Ignoring them is like, well, leaving money on the table, isn't it? They can quietly eat into your returns.
Absolutely. Understanding how your broker makes money is step one.
Okay, so we know who might be executing the trade. Now let's talk about what you actually want to do. Are you just buying something you plan to own? Or maybe you think a stock is going down. But first, a quick but pretty important distinction. Discretionary orders versus solicited or unsolicited trades.
Right. This is about who's making the decision. A discretionary order means you've formally given your registered representative, your RR, the authority to make trading decisions for you without needing your okay on each specific trade.
That sounds like a lot of trust.
It is. And that's why there are higher supervisory requirements around these accounts. Now, even if you have granted discretion, if your RR discusses a specific trade idea with you and gets your okay before putting the order in, it's marked discretion not exercised for that particular trade.
Okay, so they didn't use the power you gave them that time.
Exactly. Then you have unsolicited trades. That's when the idea for the trade came purely from you, the client.
You called them up and said, buy this.
Pretty much. And if the RR recommended the trade to you and you agreed, that's a solicited trade.
Why does this distinction matter so much?
It's really critical for regulatory oversight and suitability rules. It helps track where the investment ideas are coming from and ensures recommendations are appropriate. It really highlights how important it is to be clear about the decision-making authority in your relationship with your broker.
Makes sense. Okay, now on to the main event, the actual transactions. Long versus short.
All right. So a purchase is pretty straightforward. You're buying securities. You might pay in full or use margin, but you're acquiring ownership.
Standard buying. And a long sale.
A long sale is also quite common. It just means you're selling securities that you already own. You have them in your account, or you can deliver them quickly. It's the standard way people sell stock they've previously bought.
Okay, easy enough. Now, short selling. This always sounds a bit more complex.
It is a bit different. A short sale is when you sell shares that you do not currently own.
How can you sell something you don't own?
You have to borrow them first. Typically, your broker arranges to borrow the shares, often from another client's margin account or their own inventory. Then you sell those borrowed shares on the open market.
Okay. Why would you do that?
The strategy is bearish. You do it if you believe the stock's price is going to fall.
Ah, so you sell high now.
And the plan is to buy the same number of shares back later after the price has dropped, hopefully much lower. Then you return those repurchased shares to whoever you borrowed them from.
And the difference is your profit.
Exactly. So say you short 100 shares at $50. You receive $5,000 minus commissions. If the price drops to $40, you buy back 100 shares for $4,000. You return the shares, and you've made $1,000 profit, ignoring costs for simplicity.
But what if the price goes up? You sold at $50, it goes to $60.
Then you're in trouble. You
Yeah.
still have to buy back those 100 shares to return them. If you buy them back at $60, it costs you $6,000. You originally got $5,000, so you've lost $1,000.
And theoretically, the price could keep going up indefinitely.
That's the big risk. Unlike buying a stock where your maximum loss is what you paid, the loss potential on a short sale is theoretically unlimited because the stock price can keep rising. You have to buy it back eventually.
Wow. Okay. So are there special requirements for short selling?
Yes. Short sales must generally be done in a margin account, not a cash account. And if you have a margin account, you typically sign a loan consent agreement. That allows the brokerage firm to lend out the securities held in your account to short sellers.
So my shares could be lent out.
Potentially, yes, if you're a margin customer who signed that agreement. And there's usually no fixed deadline to buy back the shares as long as you maintain enough equity in your margin account to cover the potential loss.
Interesting. And I read something fascinating in the sources about dividends.
Ah, yes, that's a key detail. If the stock you borrowed pays a cash dividend while you're short,
Mm-hmm.
you, the short seller, are responsible for paying that dividend amount to the person or entity you borrowed the shares from.
Seriously. So you're out of pocket for the dividend on shares you don't even own.
Yep. You have to make the lender whole for the dividend they would have received if they hadn't lent you the shares. Adds another potential cost to shorting.
That's definitely something to remember. Okay, and just briefly, you mentioned options earlier, covered versus uncovered.
Right, just a quick connection.
Yeah.
When you sell a call option, you're giving someone the right to buy stock from you at a set price. If it's a covered call, it means you actually own the underlying stock already. So if the option gets exercised, you can deliver the shares you own. Lower risk. An uncovered call, sometimes called a naked call, means you sold the call option, but you don't own the underlying stock. If it gets exercised, you have to go out into the market, buy the shares at whatever the current price is, which could be very high just to deliver them. Much, much riskier. Requires a margin account.
Definitely sounds riskier. Okay, so we know who does the trade and whether we're buying long or selling short. Now, how do we actually tell the market how we want this done? This is where the different order types come in, right? And this seems really important.
Absolutely critical. Choosing the right order type is how you translate your strategy into action, and it can make a huge difference to your results. Let's start with the simplest one, the market order.
Okay, market order. What's that?
It's basically the default, the simplest. You just tell your broker buy or sell without specifying a price.
No price. So what happens?
It gets executed immediately, or as close to immediately as possible, at the best price available in the market at that exact moment. For a sell order, that's the highest current bid price. For a buy order, it's the lowest current ask or offer price.
So the big plus is speed and certainty of execution.
Exactly. You're pretty much guaranteed to get your trade done quickly. The downside, you have no guarantee on the price you'll get. It could be slightly different, maybe even significantly different in a fast-moving market from the last price you saw quoted.
When would you typically use a market order then?
Usually in very active, liquid markets, think large company stocks, where the difference between the bid and ask price, the spread, is very narrow. If you just want in or out now and a few pennies difference doesn't worry you, it's efficient.
Okay, so speed over price precision. What if price precision is actually more important to me?
Then you're looking at a limit order. This is where you specify the price.
You set the limit.
Precisely. A buy limit order means you're saying, I only want to buy at this specific price or lower. So you place it below the current market price. If the stock is trading at $31, you might place a buy limit at $30.
And it won't execute unless the price drops to $30 or less.
Correct. Conversely, a sell limit order says, I only want to sell at this specific price or higher. You place it above the current market price. Stock's at $29, you want $30. Place a sell limit at $30. It won't execute unless the price rises to $30 or more.
So with limit orders, the guarantee flips. You get your price or better.
If it executes.
Yeah.
But there's absolutely no guarantee that it will execute. The market might never reach your limit price.
Right. So that's the trade-off. Market order gets done, maybe at a bad price. Limit order gets your price, maybe doesn't get done at all.
That's the core dilemma you face with every order, prioritizing speed or precision. Limit orders give you price control, but you risk missing the move entirely. They're often useful for larger orders where you don't want to push the price against yourself, or for less liquid stocks, or just any time the bid-ask spread seems wide.
Okay, that makes sense. Now, what about stop orders? I hear them called stop loss orders a lot. Are they for limiting losses?
Primarily, yes, but they can also protect profits. They are contingent orders. They don't do anything immediately. Instead, they lie dormant until the market price hits a specific stop price that you set.
And what happens when it hits that stop price?
It triggers and instantly becomes a market order.
Ah, so it turns into a regular market order at that point.
Exactly. Which means, like a market order, you're assured execution once it's triggered.
But no guarantee on the exact price again.
Right. Because once it triggers, it just sells or buys at the next available market price, which could have already moved past your stop price, especially in a volatile market.
Okay, so how does a sell stop work? Let's say I own a stock.
Right. A sell stop order is used with a long position you already hold. You place the stop price below the current market price. Let's say you bought XYZ at $25. You might place a sell stop at $20. If the stock price falls to or through $20, your stop is triggered, and it becomes a market order to sell, hopefully limiting your loss near $20.
Or to protect a profit.
Yeah. Say that XYZ stock you bought at $25 goes up to $35. You're happy, but worried it might fall back. You can place a sell stop at, say, $33. If the stock then does drop to $33, it triggers the sale, locking in most of your profit.
Okay, I see. And for short positions, if I shorted a stock, I'm worried about the price going up.
Exactly. So for short position, you use a buy stop order. You place this above the current market price.
To limit the loss on the short if the price rises?
Correct. Say you shorted ABC at $40. You're bearish, but want protection if you're wrong. You might place a buy stop at $45. If ABC stock unexpectedly rallies up to or through $45, your stop triggers, and it becomes a market order to buy the shares back to cover your short position, limiting your loss around that $45 level.
So stop orders are basically triggers for market orders to manage risk. But you lose that price certainty once it triggers. Is there a way to combine the trigger idea with the price certainty of a limit order?
There is, and that brings us to the stop limit order. It's a hybrid.
Okay, how does that work?
Like a regular stop order. It's activated when the market hits your specified stop price. But instead of becoming a market order, it becomes a limit order at a price you also specify, which can be the same as the stop price or different.
Ah, so it triggers, then it has a price limit.
Precisely. So
Okay.
you get the potential benefit of executing only at your limit price or better, but you also inherit the risk of a limit order. It might not execute at all if the price moves past your limit after triggering.
So more control, but again, less certainty of execution.
Yeah.
Can you give an example? Say a sell stop limit.
Sure. For a long position, let's say you bought DEF at $15. You want to protect yourself if it falls, but you don't want to just dump it at any price if it gaps down hard. You could place a sell stop limit with a stop price of $10 and a limit price of $10.
Okay.
If the market price drops to or through $10, the order activates. But it's now a sell limit order at $10. It will only execute if someone is willing to buy from you at $10 or higher. If the price instantly drops to $9.90 after hitting $10, your order won't fill unless the price comes back up to $10.
So you avoid selling into a potential panic drop below $10, but you risk holding on to it if it keeps falling.
Exactly. It's a finer control, but with that risk of non-execution.
And a buy stop limit for a short position, placed above the market.
Same logic, reversed. You shorted GHI at $20. You want to limit your loss if it rises, but maybe not chase it too high. You place a buy stop limit with a stop price of $24 and a limit price of $24.
Right.
If the stock price rises to or through $24, it triggers, becoming a buy limit order at $24. It will only execute if someone is willing to sell to you at $24 or lower. If the price jumps straight to $24.10 after hitting $24, your order won't fill unless the price comes back down to $24.
Got it. More precision, but you might miss your chance to cover if the stock just keeps running higher.
That's the trade-off. These offer more control than simple stops, but you need to understand that added risk of non-execution.
Okay, that covers the main types of orders. Now, finally, besides the type, are there instructions about how long an order should stay active?
Yes, absolutely. These are often called order qualifiers, focusing on time. The default, unless you say otherwise, is a day order.
Day order. Pretty self-explanatory.
Mostly, yeah. It's good for execution only during the regular market hours on the day you place it, typically 9:30 a.m. to 4 p.m. Eastern Time. If it's not fully executed by the close of trading that day, any remaining part of the order is automatically canceled.
Okay, so it vanishes at the end of the day if unfilled. What if I want my order to last longer? Say, that limit order I placed below the market.
Then you'd use a good till canceled order, often abbreviated as GTC, sometimes called an open order.
Good, till canceled, so it stays active until it fills or I cancel it.
That's the idea. It remains on the broker's order book day after day, waiting to be executed at your specified limit price until it either gets filled completely or you proactively go in and cancel it.
Do they just stay there forever?
Well, brokerage firms usually have policies to periodically update or confirm these GTC orders, maybe every few months, just to make sure they're still wanted. And they track any partial fills along the way. You can also usually specify a shorter GTC period, like good for a week or good for the month.
Okay, so you have options for how long the order stays alive.
Definitely. Day order for short-term intentions, GTC for longer-term price targets.
Right. So bringing this all together, what does this really mean for you, the listener? We've journeyed from, the basics of how your broker gets paid all the way to these pretty sophisticated order types you can use to protect your money or execute a very specific market view.
Yeah, I think the key insight, if we connect this to the bigger picture, is that understanding these details, it really transforms you. You move from being just a passive participant, someone clicking buy or sell, to becoming an informed strategist.
A strategist. I like that.
It lets you really tailor your approach. You can match your order type and strategy to the specific market conditions, to the liquidity of the stock, and crucially, to your own personal tolerance for risk. It's about moving beyond just simple buying and selling to actually, mastering your orders.
It seems like the financial markets, while they look complex, maybe a lot of that complexity is actually designed to give you more control, more options, if you know how to use them.
That's a great way to put it.
So here's a final thought to leave you with. Now that you know about market orders, limit orders, stops, GTCs, how might strategically combining different order types let you pursue more nuanced investment goals? Think beyond just simple purchases or sales. How could you layer these tools to manage risk and opportunity in more sophisticated ways?